Hey y'all, today we are looking at a ETF from Simplify. It's called the Enhanced Income ETF, and we're going to go through it. I'm going to try to explain to it. We're going to look at the summary prospectus and try to figure out how they're making their money. It is brand new, so we don't have any history. We don't know what the yield is. I'm going to try to give you my guess later on in this video, so stick around for that. And I'm going to tell you how I think it missed its mark. So, if you're new here, like, share, subscribe, do all that good stuff. Down in the pinned comment down below is the Amazon link. When you guys shopping for Christmas or Hanukkah or whatever you do, please consider using my Amazon link. It doesn't cost you any extra to use it. Just click it, make it your homepage, and use it all the time. Any purchase you make, Amazon will send me a few pennies my way for you doing so, and that I would definitely appreciate that. So let's get into it. So from Simplify ETFs, this is called HIGH, and currently it runs about $25.21 per share. Now, what does it do? Well, let's take a look at a fact sheet. So, real quick, the Simplify Income ETF seeks to provide monthly income by selling short-dated put or call spreads on the most liquid global equity indices. The fund is intended to be an alternative high-yield solution as it seeks to provide significant income with low correlation to traditional credit and duration exposure. A sophisticated option writing algorithm seeks to sell spreads that generate attractive risk-adjusted returns, while an additional layer of risk management helps manage tail risk associated with selling options. This is just professional speak, right? Because none of this is really telling you anything. It's trying to make it sound good, like high yield solution, right? Significant income. These are key words to really key in on. It will distribute monthly distributions. It has the algorithm, so if it's got the algorithm, it must be good. Let's see here. What else we got here? Selling spreads on equity indices can be a source of high income with minimal duration risk and low beta traditional credit. Hence, this fund can be used as a diversifying alternative to traditional high yield. What is traditional high yield? Is that high yield bonds? High yield stocks? I'm not sure because they don't really tell you. But this is excess cash invested in short-dated treasuries, so treasury bills. So what I think this fund is going to do is be just a little bit better than a savings account, right? Right now, savings accounts are over 3%. So I'm thinking this might land in the 4 to 5% annualized yield. We'll do a little exercise and try to figure that out here later on. It does have a gross expense ratio of 0.51%. And then current holdings as of this date of this, it does not have any, but they do have some. So let's take a look at their strategy real quick. Interest income strategy. So, whoops, I better not do that. That makes it look ugly. The fund invests primarily in interest income producing U.S. Treasury securities such as bills, notes, and bonds, and fixed income ETFs that invest primarily in U.S. Treasuries. The fund targets an average securities portfolio duration of 2 years or less, so short duration. If you guys remember, I did that TLTW video. That's a long duration bond fund, 20 years long. What this is doing is getting the short term 1 to 2 year bonds in there. which typically will have less price movement. It'll be less susceptible to interest rate hikes. The 20-year will, go up and down. If you look at like maybe a Tilt W share price, you'll see that it's up, down, up, down. You look at something like this, it's probably going to be fairly flat. So if you want low volatility, this might be one to go with. Let's see. So speaking about the duration, it is a measure of the price sensitivity of a debt instrument when interest rates change. For example, if a note has a duration of 1 year, a 1% rise in rates would result in a 1% decline in price. The advisor selects securities to maximize portfolio yield within the current duration target, and the advisor sells securities primarily to adjust portfolio duration. So they're trying to keep it into that short-term box where the price isn't so volatile. Now, the option strategy. To generate additional income, the fund employs an option spread writing strategy on equity ETFs and fixed income ETFs. Now, what I've seen is they're doing it on a index and not on ETFs, not on fixed income. But this is actively managed, so it may change from month to month. The advisor focuses on index-based domestically traded ETFs, for example, such as those linked to the S&P 500 or the Bloomberg Bond Index. So let's look at the option strategy. So they'll do two things, depending upon where they think the market will go or where their fancy algorithm tells them what to do. So a call spread, when the advisor believes an ETF's price will decrease, remain unchanged, or only increase slightly, it employs a call spread strategy, and that's actually what they have on currently. In a call option spread, the fund writes an out-of-the-money call option while also purchasing a further out-of-the-money call option. And what that does is prevent if the index that it's sold on went up like in a fast way. Gosh, that was horrible. Why do you guys watch these videos? If the index spikes, right, the purchase of the out-of-the-money call option will help cushion the loss that it will receive from the price spike, right, by selling a call option. Lord have mercy. Now, when the advisor believes an ETF price will increase, remain unchanged, or only decrease slightly, it employs a put spread strategy. In a put option spread, the fund writes an out-of-the-money, below current market price put option while also purchasing a further out-of-the-money put option. So it's the same thing. But what these people are doing is they're doing super conservative option spreads. So the advisor expects the written options to expire worthless, but purchases lower cost further out of the money options to insulate the fund from large losses. If the written options increase in value, the advisor expects options to be held to expiration, but may adjust positions following a large over 10% price swing in an options reference ETF. So let's take a look at what that means, right? I'll drop you in here to Interactive Brokers, and we'll do that. First, I wanted to see. Oh man, is it not in here? Here it is. Here is their holdings as of July 17th. Now, I don't know when they put these on, so I don't know what the value of these are, but they have sold 67. When you see a minus, they sold them on XSP November 25th, $413 calls. They sold 67 of them. And then they went way out and bought 67 $450 calls. So if they were to spike in a big way, then these would be profitable, these would be unprofitable. But the likelihood of them getting up to the 413 is probably very, very small. And then you'll see that the vast majority of what they have on here is in treasury bills. So, only 0.04% is in these options. So it's really just about the treasury bills yield plus a little bit of a boost. Okay. So now let's jump into interactive brokers. Now I already got the XSP index up here, and let me clear these and let's go with, I don't know how far out they sell them, but that one is currently November 25th at 413, and it's only worth 8 cents at this point. So let's go out a couple more weeks just to get maybe a guess. You know what? Let's do 4 weeks. Why not? So what they would do is they would sell in a call option spread. If they think that the market is going to go down or remain unchanged, they would go on the call side. So they would sell this 420, right? And they would go down way down here and maybe buy this 450. Okay. Now we saw that they did 67 of those. So let's go 67. Actually, I already have that completed there. And the mid price between that, let's just say they get $1.50, right? So we have $1.50 per contract. That's times 100. So they'll get $150 per contract, right? Times that by 67 contracts. So they collected, this is theoretically, I'm just guessing here, okay? But this is kind of how they run their business. So $10,050 received for a 4-week call option spread, okay, at 420 and 450. So that's what they received. Now, I said I was going to tell you about what they're going to yield. So let's find out. What we need to know is this 10,050, right? If that were to expire worthless, is what they expect it to do, they would distribute that to the shareholders. So what we need to know is how many shares is outstanding at the moment. And we'll find that here. Shares outstanding, 100,001. So we'll take the 10,050, divide that by 100,000. That's kind of weird that there's 100,001 shares. And that equals 10 cents. 10 cents per share. So we'll times that by, no, I'm sorry. That's, is that right? Whoops. 10%? No, that's not right. Yes, that is right. 10,050 divided by 100,001 share equals 10 cents. Okay, so 10 cents a share. So we divide that by the net asset value right now, which is $25.22. That equals 0.003. That's times 100. That will figure out your percentage. So 0.39% times that by 12 to get an annualized yield. And the annualized yield, 4.78%. That's just a guess, okay? That doesn't include the treasury yield that they're going to get as well. So maybe they'll get a couple of percent there. So maybe this is going to yield 6%. I don't know. That's my guess, okay? Am I going to be right? Probably not. So keep this one on your watch list. I was going to tell you where this missed its mark. Well, I mean, obviously, if you're going to have an ETF called HIGH, H-I-G-H, this somebody in the cannabis industry really should have scooped up this ticker, and they didn't. So that's where it missed its mark. So hope you enjoyed. If you're looking for something that's going to be fairly stable, decent yield, we don't know yet. I'm just guessing at that. High might want to be on your watch list. We'll check it out. I'll give some updates on the community tab if I remember, and when they put out their first distribution, we'll check out what the yield is and all that stuff. And yeah, hope you guys enjoyed. You have a good weekend, and we'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.